basics, what the hell is actually a tariff? Just to get super clear, a tariff is a tax that the government imposes on goods that we import from other countries. So when we instituted 10% tariffs on basically every country, most countries, that means that any good coming into the United States is now taxed 10%, and that money goes to the government, just like how we pay income taxes and sales tax and things like that. Trump's goal is to encourage U.S. manufacturing production, which would promote domestic industry, which would then protect our working class citizens and keep their jobs. It would also, it absolutely does increase tax revenue, at least if people are still importing goods. And we'll talk about why he wants to do that. His goal is also to reduce the trade deficits because other countries have very high tariffs on the US. So it costs us more money to export to a lot of countries because they have, 20, 30, 40% tariffs on US goods. So in his eyes, he's trying to level the playing field. Well, they have 30%, so we're going to do 30%. They have 10%, so we're going to do 10%. And then his goal is also to use it as like a temporary strategic negotiation tool. Okay, so, and then a quick history of tariffs. So this lovely little chart here is tariff rates since the 20s, right? And the green dot in the top right where it says estimated with the announcement, I mean, that's pretty accurate because it's about 29%. So if you see it's right under 30%. So that's where we are today in that green bubble on the top right. And this little light blue dot is where we were before the announcement this week, due to all of the tariffs that he already put in place, over the last 2 months or so. And then you can see where we were for a couple of decades, many decades. And then one notable thing is that in the 30s, like in 1930, there was the Smoot-Holly Act, which also raised tariffs to about 20%, not even what we're at now. It did not go well. I mean, it basically crashed the economy, but they did not have inflation. There was no inflation. Mostly because they went into a recession and no one was spending any money. And so goods actually got cheaper. So I think that's important context, historical context. So those were the goals. But the reality, at least in the short term, in the next couple of weeks, months, year-ish, right? So prices will likely go up and people are going to kind of panic about it, as they are. But it should also raise $300 billion in tax revenue. And most of this all went into effect immediately. There are some specific tariffs that went into effect or will go into effect, I think, like next week or something. But for the most part, they've gone into effect immediately. So that's only on like new imports though, right? So that's important because a lot of companies already kind of predicted this. And so some of them have existing inventory. So they're not passing that cost on for their existing inventory. But when they need to import again, they're going to have to figure something out, right? Great. So then when we look at which goods would actually be affected by this, because we don't import everything, right? We make some stuff. So a couple of the important ones that I noted was, so there's US made cars, obviously, and those will be fine, but the imported cars, so Toyota, Honda, and GM all import from foreign countries. So those ones will get more expensive, and they estimated between $3,000 to $6,000 more. And then Apple pretty much makes everything in China, or whatever, or Asia, whatever. And so that's all going to get more expensive. So they said iPhones could jump $200. TVs would get more expensive. Pretty much all electronics. And then clothing. So Walmart and Target, like fast fashion type clothing stores, those are not made in the US, but there's obviously a lot of clothing that is made in the US. But yeah, the cheap clothes at Walmart and Target may get more expensive. And then a cool stat that I heard was that 99% of shoes are made in Asia. So they're estimating those shoes could increase by 20 to 30%. And then some food, obviously not all food, but things that we have to import, like avocados and berries and bananas and things like that. The things that are going to get the most expensive is probably cars and like appliances for your house and things like that. So those would be the big ticket items. You'll save thousands of dollars if you just. And my financial advice again would be probably to finance it, because if you're not sure what your job situation will be, or, I mean, it's up to you guys, but like, absolutely do not want to have to sell any investments right now. Absolutely do not sell investments right now. That's the main reason that I said to finance it, so that you can keep that cash on the sidelines, because you probably won't be able to sell investments for some time, you know. I mean, I don't know how long. I mean, it could be weeks, months, but I don't know. You know, I just, you never want to be unprepared. Yeah. So and I was listening to some other things that said, you know, there could be some supply chain chaos like we had in 2020 and 2021, when basically transport and trade kind of stopped because of other reasons. But as you can remember, like the toilet paper crisis, we had, I remember I had such a hard time furnishing. Like I moved to a new apartment in 2021, and then I moved to my new house in 2022. It was horrendous buying furniture. Like there was nothing available. So
Sure.
we don't know where prices are going to go with all this, but there could be, these are like what could happen. We could have supply chain chaos, right? We could have difficulty getting things that you normally get, like your favorite snack. Or your Target clothes runs are like, you know, my Target runs might not be as fun. This is a great opportunity to buy local. Yay! Support your local farmers. Support your local businesses that don't import from other countries, I guess. Support local artists, you know. Yeah. Those things are not gonna necessarily increase in price. So unless there's a supply demand issue, we'll see. And then instead of shopping at like Target, maybe you actually shop at like a US made clothing brand. Okay, so do tariffs cause inflation or deflation? This, like the economists are all going to say that it's inflationary, but there are some people who say that it's deflationary. So I wanted to share the reasons why it could be either, and that in the past does not appear that tariffs have been inflationary, but for some of the reasons on the right-hand column. So the reasons it could be inflationary, right? Obvious ones, the prices on imports are going to spike. Supply chains are disrupted, so there's not as much supply, which raises prices. There could be trade wars. Countries are kind of pissed, and then they might, now everything's gonna everything gets more expensive for everybody. And panic buying, like the COVID toilet paper crisis. Sharon was already on that. But there are some ways that it can be deflationary. So, and these aren't as obvious. So tariffs can strengthen the dollar. So when the dollar is strong, Americans that have US dollars can buy a lot more goods in foreign countries because the dollar is stronger than the euro. So you can, when it's strong, you can buy more stuff overseas. It's a favorable exchange rate for you. When the dollar is weak, it means more foreigners from other currencies. Now the dollar is weaker, so they can actually buy more products and goods and services in US dollars. So it becomes cheaper for them. But for Americans holding US dollars, it's less favorable. You're not going to be able to get as many, it's going to cost more dollars per euro for you to do your exchange. Does that make sense? Let's start with this graph. So this is the dollar. When it's high, this means the dollar is strong. When it's low, it means the dollar is weaker. Okay, so we can see some trends, like in the 80s, the dollar was very strong. And we can see in the financial crisis, the dollar was not strong. And then we can see basically since the financial crisis, the dollar has gotten stronger. It's a lot of ups and downs. I mean, the exchange rate changes all the time. It trades like an equity, but like constantly. It trades more like Bitcoin, the value of the dollar. So that's over time. So this is like the last 5 years. So the dollar weakened when the economy was doing really well, like in 2021. And then the dollar got stronger when we started to raise interest rates, blah, blah, blah. And then it's pretty much kind of like been steady, but it's kind of come down a little bit. It was at another low in September of last year, but then this dollar started getting stronger again, and then the strength of the dollar peaked again in January. This is important for Bitcoin as well. So now let's zoom in here. I think this one. All right, so we can see on January 9th, the strength of the dollar peaked. And at that time, January 12th, 13th is when Trump was inaugurated. He came in and he said, the dollar is too strong. We got to get the dollar weakened. Because when the dollar is too strong, the rest of the world can't afford American stuff, right? And so they don't spend money. So there's less like liquidity. They're not spending money. They're not buying US stuff. They're not buying US goods and services. So it's actually bad for our economy. Does that make sense? So he said the dollar's too strong. And so he immediately started making all of these changes, and you can see it's pretty much steadily come down, 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 down. And you might notice, oh, in January, I could get more for my money, and now I can't. All right, so right about here was February 20th, 21st or so. Yeah, and you can see how the strength of the dollar sharply declined right here. That was late February when the market had its first, tumble for a while. And then you can see as it had its second tumble this week, the strength of the dollar came down even further. And so now the dollar, it's come down a lot. So I just wanted to explain, when they say that tariffs could be deflationary, it is because of the dollar strength, and that's part of it. Okay. So then manufacturers, retailers, Walmart, blah, 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 producers, they could, because of this, they all, as businesses, they do have the option to make changes themselves without passing it on to consumers. So those companies could cut back, they could lay off staff, they could, just get more efficient. They could absorb a little bit of the cost, that would cut into their profits, but they could absorb it. If this happened, it could be deflationary, okay? Or the manufacturers, right, they could force the suppliers in the foreign countries to just eat the cost. All right, so that, if that happens, it could be deflationary. The other one is production shifting domestically. So if we start making stuff in-house and now we're not paying for transportation costs in-house, then the goods technically should be cheaper. And then this is the one, this is why it was deflationary in the Great Depression, because tariffs, also, we've got recession fears going along with the tariffs, and recession fears usually then there's less demand, because people are scared, they don't want to spend more money, they're going to cut back, so now people just aren't spending money. And then Besant, he has described, I am trying to understand what they're doing here. I'm trying really hard. So he says he says, think of it like a shrinking ice cube, that at first you're going to have a lot of revenue, and then the revenue declines from tariffs as production shifts to the US. Then there's more US factories, which means more US jobs, which means more US income, which means less reliance on imports. And then if that were to happen, it could be deflationary. Okay, so the current administration's plan and goal is for tariffs to be deflationary and to lower borrowing costs for Americans. Another meme for you, but you guys may not understand this one. Okay, so the administration's goals, right? They want stronger domestic production, but they also want lower yields. So there's the 10-year yield for bonds, and right now it's been at like 4.5%, right? So it's basically the same that you're getting on your savings account. Think of it like that. So the yield you're getting on your savings account is basically the 10-year yield, essentially. It's not exactly, but like think of it kind of like the same. So the yield is kind of high right now. And this also means that it's more expensive to borrow money, right? So the administration wants lower yields on the bonds so that it's cheaper for Americans to borrow money to buy cars and to buy houses. Their other goal is to have higher after-tax income because they want to actually lower income tax as well. And then we'll get to that in a minute. And then the overall is that they want to have an economic shift from reliance on the government stimulus, which is what we did during COVID, right? During COVID, we just printed money, and now there's more money. And that printing of money is what stimulated the economy. So So the administration wants to move away from that, and away from the government borrowing more money, because every time they print more money, right, they have to borrow more money to do that. So that's what makes our debt so high. That's why our debt's out of control right now. So they're working on the debt, essentially. And so they want to get the United States into a sustainable economy that can sustain itself without the US just printing a ton of money and pretending like the country is actually economically viable. I do like to say that if the United States were a business, like if it were a business, it would be it should be bankrupt, to be like it should be. Yeah, so this meme here, if you don't buy my bonds, I'm going to burn your equities and then you're going to buy my bonds. Essentially, if equities are doing really well, people aren't really going to buy bonds, right? Because bonds aren't doing well. The yields are low, but not like they're kind of high, but like not enough for people to worth buying, right? So I think we talked about this in another call where we talked about how like they're not really, like a lot of governments and a lot of people just aren't buying bonds, right? So they're like, okay, well, if you're not going to buy bonds, well, then I'm just going to burn your equity to the ground, which is the stock market crashing. And then you're going to buy bonds, which is happening. And when you do that, then the price of bonds goes up. And when the price of bonds go up, the yield on bonds comes down. His goal is to get the 10-year Treasury yield down, and he is accomplishing that in one way or another. Okay, and so he wants it down because borrowing gets more expensive when it's high, like in the past couple of years. It's been very expensive to borrow money. And then when it's low, like pre-2020, it was very cheap to borrow money. And that generally stimulates the economy. So that's the plan, that if borrowing is cheaper, more people will buy homes, more people will start companies, they'll spend more money, and it'll make the economy grow faster. Another key component of the yield and the bonds is that when the bond yield is high, the government has a lot of debt. And the biggest expense right now is actually the interest on that debt. I think the interest on the debt is in the trillion. It's like 1 trillion a year or something. And that's just from the interest on the debt that we carry. So if you can get the 10-year yield down, then that debt also goes down. The interest on the debt. It's not as much interest. Yeah. And the plan is that if tariffs then bring in income, it would raise money to reduce this national deficit that we have, to fund federal income tax cuts. The next part of his plan after this, which according to him is finished, is to extend the Tax Cuts and Jobs Act and then cut taxes so that there's no taxes on tips, no taxes on overtime, and no taxes on Social Security. And the idea is that by doing that, then more people have after-tax money to spend. So people would be better overall. And then another part of his endgame plan is to produce more energy, and then that makes energy cheaper. So then fuel, utilities, and transportation costs is cheaper, which keeps inflation down. If it works, then there could be cheaper housing, cheaper US cars, cheaper gas prices, more business investment, tax cuts, more jobs, blah, blah, blah. But it's extremely risky. It could entirely backfire, and that's where we are. The market is pricing in a lot of pessimism about this, and I think the market was doing pretty well. Like it was kind of rebounding, because the idea going into the tariff liberation day thing was that they were basically just expecting like maybe 10% tariffs across the board. But not all of these really extreme tariffs. And so it's just so much more than the market was expecting. Part of the tariffs is also serving strategic negotiation purposes. So he's saying, hey, we're putting tariffs on you. And he wants all these countries to call him up and make a deal. And then he'll be like, all right, cool. You made a good deal with me. So we're going to put you down to 10% or something like that, right? I'm gathering that there's two things going on. One is that Trump has always, he's been on record saying for like 40 years that he just believes that the tariffs are unfair for the United States. And so he wants to have like the blanket 10% tariff across the board. I don't necessarily think that that's going to disappear. I don't think that this, he's not going to change his mind on like, oh yeah, maybe we don't want tariffs. That's not going to happen. What he is negotiating with, and you've seen him do, is that he'll put a tariff on there, and then it'll instigate the country to then make a negotiation with him, and then he'll either temporarily remove it or lower the rate, blah, blah, blah. But it's not going to disappear completely, no. How will we know if things are working? Well, I mean, I think that immediately we can look at the economic indicators to see how the economy is doing. Those are objective indicators that will tell us sort of the health of the economy. We'll be able to see interest rates. We'll be able to see inflation. We'll be able to see employment. We'll be able to see manufacturing spending. Like these are all things that we have objective numbers for. And if those things go south for a really long time, then we know it did not work. And we will know probably in 6 months if it's going the way it was planned or not. And yes, it does take time to build factories and whatnot, but that's his plan and his thinking. And I'll also say he only has, he has like a timeline where he doesn't really care about his ratings right now, but he's going to start to care about his ratings in like 2 years. He's hoping to see it much sooner than 5 year. So what to do with your investments? Mom was asking, well, should this change my investment strategy at all? Well, no. Well, no, you shouldn't sell, but it does sort of does change a little bit, because this is honestly such a drastic drop. I think the Dow and the NASDAQ, I think, are officially in bear market territory, which is more than a correction. So yeah, the S&P 500 is not quite in a bear market yet, although I don't know what the market's done in the last hour and a half. Yeah, so my point is that it's a pretty significant drop. And so I would say in these significant drops, this is also a huge opportunity. If you have any money on the sidelines, you would put it in the market. And I'm not saying today, because I don't think this has settled yet by any means, but I would say I would keep an eye on it, and I would start thinking about, when could you put some money into the market? And I'm not as much speaking to my elder ladies on the call here, because your accounts are kind of tapped. You guys don't have income coming in, so there's not really a whole lot you can do. But yeah, at the bottom of markets like this is an opportunity. It's when rich people make the most money, is with this. Think of the COVID correction, right? So during COVID, everybody panicked. The market sold off super fast. I think it was March 20th or something like that. And a ton of people were scared and they sold and they put everything in cash because there was a lot of panic, a lot of uncertainty. They didn't know how the world was going to go. I mean, if you remember, that was a very uncertain time. I felt like it was much more uncertain than it is now. Although if you look at some of the graphs, charts about economic uncertainty, right now is actually the highest level of economic uncertainty that we've had on record in decades. But my point is, so a lot of people sold because they were really unsure and they were scared, and they missed out on one of the biggest rallies post uncertainty ever, right? So you see this chart here. This is returns a year after a spike in policy uncertainty index. So these on the bottom here are the times where there was a spike in this policy uncertainty. So this is, if you look on the right, it says March 20th. So that was the policy uncertainty of March 2020, when nobody knew what was going on with COVID, and the market crashed a lot suddenly. But then this bar graph here is then saying how much the market returned 1 year after that spike in uncertainty. The market returned 63% in the following year after that. And then February 2009 is the second one. So February 2009 was basically the highest point of uncertainty for the financial crisis. And at the peak of February 2009 was the peak of financial uncertainty. And then 1 year after that date, after that month, the market returned 50%. Now, I just want to point out that the average return for the market is like 9 to 10%. Which is on the left side of this graph. And there have been other times. So in April 2020, there was also, uncertainty. In March 2003, January 2013, January 2024, that was like earlier this year. And then let's see, the October 92, nobody here is, we're not going to remember that. August 2011, and then we see September 2001, which we all know why there was uncertainty then. That was a little bit of a different uncertainty though. That was the one time where a year after September 11th, the market returned negative 17%. And then from September 2008, it also returned negative 9%. But then you see from February 2009, it then returned 50%. So it took a lot longer for the financial crisis to rebound. But these are all different scenarios, right? But the point is that some of the most drastic downturns have the most drastic responses and returns. So on the far left and the far right were the most extreme levels of uncertainty. 2003, 2011, 2013, 2000, like those were not huge market drops. So these ones on the far left and far right were like large market drops. So we don't know which one it'll be, but I think for a more conservative portfolio, it's not like, oh, hey, you've got like some money in cash on the side. Let's put it in the market. It's like, well, you still need that cash. So we're probably not going to deploy that cash for you. But for people in their 20s and 30s and 40s, you definitely do want to do that. There's also, I wanted to bring out something potentially hopeful. So there's this guy, this is a Bitcoin guy, a Bitcoin PhD analyst guy that I follow. So he produced he has a company that does Bitcoin intelligence, and he put out this Bitcoin intelligence report. this is what he thinks is happening. This is what he thinks is like the playbook of this year and what's happening. So in the beginning, right, we had the initial shock of all these policy announcements. Things were really psychologically uncertain. Then we had like the Liberation Day, and you saw that like this is also Bitcoin wasn't doing super well, right? Bitcoin came down from its peak in December when all of this started to take place in January and February. So the red boxes here on the left are the things that are causing the market to panic and sell and blah, blah, blah. And then the green boxes are the things that would encourage Bitcoin investment, I suppose. And the first one on the left there is dovish Fed, leaning toward rate cuts. So because of what's happening, the Fed was like, well, they stopped raising rates and they started lowering rates, which generally is good, right? So then interest gets lower. But then the Fed was like, okay, well, we're not going to lower rates anymore because we're worried. We still need to keep an eye on inflation. So now with the situation the way it is, if they're worried that we're going into a recession, then they may be forced to cut rates again. There's a high probability now of 3 to 4 more rate cuts this year in 2025, which would lower interest rates by 0.75% to 1%, which is pretty significant, which is technically good for the markets. So the idea is, okay, February, March, we have this initial fear, the market slows down. In April, we have the Liberation Day. There's starting to be less uncertainty, but we have a lot of uncertainty, but less because now at least we know what the tariffs are. And now we're kind of like hitting a bottom. And then he's calling for the recovery, that Doge won't be able to substantially cut anything. It's probably unlikely that after all of their cuts that they actually made a huge dent. So then the Fed is going to cut interest rates, which adds to more liquidity in the market, because when you lower interest rates, then more people borrow money. And when you borrow money, you then spend the money. So that puts a lot of money into the economy. And the biggest driver of Bitcoin price growth is liquidity, because Bitcoin is not a US stock. This is an international asset for the world. So you can't think of it as just what's going on with the US. If you think back to what I just said earlier about the value of the dollar. So if the dollar is weakening, right, that means that foreigners can afford to buy more. And then if there's more liquidity and money circulating in the market, that means that there's more money for the foreigners to then buy Bitcoin or buy US stocks. I don't know what they'll do. So now money flows back in from international investors into Bitcoin. Then later in the year, we have cheaper energy, because that's a goal of the administration. And then the administration wants to cut taxes. So then there'll be tax cuts, which puts more liquidity into the market. And then we have more growth and Bitcoin will take off. This is his projection. So ISM and the PMI above 50 predicts expansion. That is the manufacturing index. Are manufacturers manufacturing? That's like the big one. And that's going to be important, because that's definitely going to be related to imports, exports. Like, are they Yeah. Are we manufacturing stuff at all? This is going to be an important one, because if we're saying, we expect that more manufacturers are going to start manufacturing in the US and it's going to bring jobs here. Okay, well, let's look at the ISM, which is going to tell us about manufacturing data. I think the last I checked, it was 49. So it had, from the prior month, it had decreased. It was like 50.5 or something. The last one came in at 49. So it was expanding, and now it's contracting this month, and we'll have to watch to see if it continues to contract or if it goes back up. ISM is Institute for Supply Management, and then the PMI is the Purchasing Managers Index. But it's basically the same thing, because the PMI is like the index number, and then the ISM is the group that produces that number. But they're used interchangeably. Yeah. And then the other leading indicator is the money supply, the liquidity, how much money is circulating. This is an important one, because when there's more money circulating, people spend more money, right? I like drilled this into you guys a lot, but that if there's more liquidity, that generally means the economy is doing better or will do better. Okay, so are we in a recession? The technical definition of a recession is 2 consecutive quarters of negative GDP. We have had, so this is a very lagging indicator because we're looking back at the last quarter of data to tell us if we're in a recession today, right? So it's not telling us if we're in a recession today. It's telling us if we were in a recession before. But the Q3 of 2024, so this is already a long time ago, the GDP was 3.1%. And then for Q4, it was 2.4%. And we are awaiting the GDP number for Q1. So we'll see. But even if Q1 comes in negative, if Q2 comes in positive, it means technically no recession. So it would have to be 2 consecutive quarters of negative GDP. Yeah, and then the lagging indicators are going to be things that kind of tell us, again, like where we were, like the GDP. So the Fed signals, is the Fed lowering interest rates? Does inflation stay low or does it rise? It's currently low. And unemployment is going to be a big one. We need to watch that, because currently unemployment is very low. But personally, I think unemployment is going to rise, but that's just, there's a lot of economists who don't think that, but I personally think, from what I hear, the working class and like the lower class, they're working like 4 jobs and still paycheck to paycheck, you know, so they may be employed, but they don't have full-time employment. They might have a part-time job here, a part-time job there. I don't think that all the jobs are going to be manufacturing jobs, because there's so many other things at play too. Like AI is coming in and probably going to lay off a lot of people from their jobs. Right now, there are robots in manufacturing plants, yes, but they still need humans to like oversee them, and they can't do all tasks. They're basically just more efficient. But AI is going to replace a lot more of like the knowledge workers, which is not really the working class type of jobs. So when we're talking about working class type jobs, we're talking about like electricians. And there's just so many moving parts right now. Like if it were just tariffs, like I'd be like, oh, maybe we could have more of an idea of where this is going. But it's not just tariffs. Like we're dealing with a lot of moving parts. The whole world is changing. Everything that we thought we knew about work is changing. I mean, if you don't, I don't know. I mean, Americans are extremely privileged, right? And we're used to just getting whatever we want super cheap. And that's honestly, it's just not sustainable. I mean, I mean, that's like, we're used to getting cheap vanilla, like, but like, why? Just why? If we can't produce it, then why do we deserve to have it? The wealth divide is so great now that if you're like, if you have a house and you can eat food and go to the grocery store and buy what you want, you're extremely privileged. That's not most of America. So unfortunately, all of like, I'm not that concerned about a lot of these tariffs because it's not really going to affect me that much, you know? But who is it going to hit the most? It's actually going to hit the lowest income population. Like, it's going to hit them the hardest and the most. Like, I mean, if something goes up $20, like, they may not be able to buy it. You know? So yeah, I don't know how it's all going to go, but things, this is my point, is we don't know how it's going to go because we don't know how the tariffs are going to go. We don't know how consumers are going to react. We don't understand what's going on with the wealth divide. We don't know how the rich are going to respond versus the poor. Like, we don't know. And then we have AI, which is changing everything so rapidly. I could have another entire series on just that. If you talk to people about AI stuff, I mean, they're kind of like, honestly, none of this even matters because they think the economy is going to do so well because AI is literally going to improve like, I listened to a podcast where a guy was like, oh yeah, the GDP is going to be 10% per year because of AI. People aren't even going to need to work anymore. I mean, at least in the short term, AI is going to remove a lot of jobs, but then a lot of new jobs are going to pop up, you know? So it's like, you know, when we started having, you know, factories with factory lines, we were like, oh, we don't actually need that many people in the factories anymore. So what is everybody going to do? The Industrial Revolution, like, we're all going to not have jobs, but we created a new economy. We created the knowledge economy. And now we have people sitting at desks staring at computers all day, and that's considered work, you know, which we never would have thought was work, you know? So we always create new jobs and like new opportunities. So we don't even know what the new jobs are going to be, is what I think. But like down the line, we are, like, I think it was even like Bill Gates was like, oh yeah, like, most people aren't going to work in the future. That everybody is just like, our economy is going to be so productive on its own that people don't have to work. And now we have to figure out what we actually do with our time now. It's like a lot of Gen Z is worried now because they're getting degrees and leaving college and then like they don't have jobs. Not because they're not smart or whatever, but like there aren't really jobs for a lot of these things. A lot of people went to school for computer science and nobody is hiring software engineers anymore. It's a huge problem for like, yeah. So I mean, Silicon Valley, there's just like a ton of software engineers and they don't have jobs. They're not unless you were already an established software engineer and you're like a senior software engineer, you're the ones that's actually, you're training the AI on all this stuff, right? But if you're a junior software engineer, you just get out of college, they're not hiring you anymore. They don't need you. And that's happening rapidly. And so, I mean, there's certain industries where I think that's going to happen a lot faster than others. The digital side is happening a lot faster. That's why, yeah. I think there was another article where some CEO somewhere said that 90% of code is going to be written by AI in the next 3 to 6 months. So it's changing software engineering pretty quickly. It's changing things like marketing. It's changing, you know, market research, analytics, finance, you know, Not working class jobs though, really. But if you do any knowledge work, you're gonna have to figure out AI really quickly or you're gonna lose your job. Okay, so I just wanted to give a quick update on where Bitcoin is in all of this with the market doing what it's doing. And guys, Bitcoin is no longer tied to the market, which is interesting. So there were market lows for both Bitcoin and the S&P 500 around the same time, March 10th, March 13th. So I took their lows. The S&P 500, as of when I published this, was down 2.5% from the prior low, like a couple of weeks ago. It's probably down 5% now. Bitcoin is actually up 5% from that low, period. So it's actually it didn't take a dip like the rest of the market did at all. So it was protective. When we talked about how it's not correlated with anything else, pretty much, right? We were that was one of like the first or second, maybe second or third Finance Fridays that we had, where I was talking about asset allocation and how adding some Bitcoin to your portfolio could be protective because it's uncorrelated, right? This is one of those cases where that helped. And so this first chart is the past year performance of Bitcoin, which is the orange line, against Solana, the green line, Ethereum, the purple line. Ethereum is really taking a beating this year. And then the red line and the blue line, the red line is the S&P 500 and the blue line is the NASDAQ the tech industry. So you can kind of see they're sort of like in the middle there. And from 1 year, Bitcoin still has outperformed, even given a lot of the volatility that it's had. And we just expect that to keep happening. So it's been extremely resilient, which is quite a relief, I think. And apparently one of the reasons for that is that there's no more sellers of Bitcoin. There's a lot of data that you can see about how many people hold Bitcoin, how where they're holding it, and there's no, the long-term holders no longer have any, like, I forget exactly what the number is, but basically there's nobody selling their Bitcoin anymore. So now there's no sell pressure because nobody's selling. Nobody can sell. They've already sold everything they're going to sell, and the people who are holding are just holding, like us. We're not selling. So that's probably one of the reasons Bitcoin has not tanked. So these last three graphs were just from today. The top one is the NASDAQ. The middle one is the S&P 500. And this is 1 month. And so you can kind of see on the right side there, the last two dips. Yeah, pretty awful. And then Bitcoin there just went up today. And then there was some news that I thought I would just share my some fun Bitcoin news. So Fidelity just announced that you can now open a Roth or IRA or regular IRA, and you can buy Bitcoin in the IRA in Fidelity's account. Not an ETF, the actual coin. You can buy it in your Roth IRA. So essentially what that means is that Fidelity would be the custodian of your Bitcoin in the IRA. So you hold it there. You're not going to sell, right? But you're not holding it. You're not holding the device at home and under the bed, right? You're letting Fidelity hold it. And Fidelity holds the Bitcoin in their own secure facility. They don't use Coinbase. They literally keep it in a vault, like somewhere. Yeah. And most of the other banks that do Bitcoin ETFs, they are all using Coinbase as their custodian. So for me, that's a little risky because I have some in Coinbase already. You don't want to like then have ETFs that are also being held in Coinbase, because if Coinbase goes down, then it all goes to shit. I feel pretty confident in Coinbase, but like always, that's to diversify that risk personally, especially as it becomes more valuable. So I don't know. I'm intrigued by this personally. The only problem is that, like, do I want to open another bank account with another bank? And then, like, yeah. So I'm also going to look and see if maybe Schwab is maybe going to do this as well, because if Fidelity does it, then maybe other banks start to follow. Schwab is pretty good about that kind of stuff. Like, you know, they're not like Wells Fargo, you know, they're an investment bank. So I don't know. Before I jump ship, I think it's best to just sort of like wait and see how the market kind of plays out with this, because I think a lot of banks are going to start offering it this year. I mean, this is why Bitcoin blow off the top this year, is because nobody's selling anymore, and there's a ton of institutional investors who intend to buy mass quantities of Bitcoin this year, whether there's tariffs or not. Like, they don't care. We got to wait and see. Like, maybe there's some other solution that comes out, you know. The other news that was pretty big in the Bitcoin world was Larry Fink of BlackRock. He's been a huge supporter of Bitcoin. He actually used to think that Bitcoin was, you know, a Ponzi scheme like everyone else. BlackRock is the largest investment bank like in the world. They have the most assets under management, and Larry Fink is the CEO, and he wrote this annual letter to his investors, this chairman letter. It just came out this week, and he talked about Bitcoin, and basically he's kind of saying like, hey, like the US debt problem is a huge problem, and if we don't control it, like everybody's moving to Bitcoin, is what he said in his letter. But he also supports Bitcoin, but he is worried that if the US doesn't get their shit together, that they would lose the US dollar as a reserve currency to Bitcoin as a reserve currency. I don't think we really know like how it's all going to work out, or how the technology is going to play out, like with the blockchain technology, and there's the whole stable coin thing going on, which again is a whole other discussion that we probably need to have on a call. But there's like legislation right now to put out a stable coin bill, and this is something that the administration is also pushing forward. So yeah, that has entirely other implications, and it's not necessarily Bitcoin, it's stable coins. But yeah, I don't even fully understand it. I need to figure that out before I talk to you guys about it. But that's going to change a lot of like what we know as finance today. Finance tomorrow is just going to look very different. But the whole issue with the debt is like, we have the debt, and then we need to pay the interest on the debt. So we print more dollars to pay the interest on that debt. But then by doing that, it devalues the dollar. So it's like this big bad cycle, which plays into tariffs, because I don't know that tariffs is the solution, right? But someone thinks that tariffs might be the solution, part of the solution to this debt crisis. And so, you know, everyone is trying to figure out, how do we solve the debt crisis? And Trump right now essentially thinks that tariffs might be the solution, right? Okay, well, if tariffs are not the solution, like, we definitely need Bitcoin. But even if tariffs are the solution, Bitcoin still has value because of other plays about how it's the backbone for the future of finance. And why is the future of finance digital? Well, because of AI. So Bitcoin comes out on top no matter which way you look at it. Whether the economy falls or thrives, it doesn't matter.